Good evening, everyone. This is Abhishek Chinchalkar. I'll be guiding you through today's webinar on RSI. So this is in continuation to last week's webinar on RSI, wherein we spoke more about the basics of RSI, including basic trading strategies using RSI. This time around, we'll focus on advanced trading strategies using RSI. So introducing myself briefly, I am the head of education at FYERS. So I lead the education desk at FYERS, and I actively contribute to our portal that's called FYERS School of Stocks, which is our online stock market education initiative. From an education perspective, I'm a CMT charter holder, and I'm also an executive MBA from SP Jain School of Global Management. I have more than one decade experience in the research side of the financial markets, with my experience ranging across asset classes, namely equities, commodities, and currencies. My primary forte lies in technical analysis and to a great extent even in intermarket analysis. So that's a very small brief about me. So as I said, we have an online stock market education initiative portal that's called FYERS School of Stocks. So this is the screenshot of the homepage of School of Stocks. So herein, I've written various aspects of the financial markets, be it relating to the basics of stock markets, be it relating to fundamental analysis or technical analysis, risk management, derivatives, commodities, currencies, etc. So we have divided each of these major topics into modules, and within modules, there are several chapters wherein we explain pretty much in detail about each of these aspects. So in case you're interested in learning more about not only technical analysis, but about financial markets in general, then you could visit the FYERS School of Stocks homepage. You could either visit through our FYERS website, or you could just Google FYERS School of Stocks and click on the first link that is displayed on Google to be redirected to our School of Stocks. So before we start with today's webinar, let me briefly discuss about what I covered in the webinar last week, which was held on last Wednesday. So back then, I spoke about the basics of RSI. So firstly, I talked about what the RSI indicator is. I then briefly spoke about an important aspect, which is relating to how the RSI is constructed mathematically. So I demonstrated that. Later on, I talked about basic trading strategies using RSI, in which I talked about a very common aspect of RSI that is called overbought and oversold zones. I talked about how to combine the RSI indicator with other tools and indicators in order to strengthen your analysis of the security that you're tracking. Finally, I also briefly spoke about the settings of RSI and how you could alter the settings of RSI in order to make it either more sensitive to price or less sensitive to price, depending on your trading style and preferences. So that was what we briefly spoke about in the last webinar. As I said, the agenda today is to focus on practical applications of RSI and talk about advanced trading strategies using RSI. So the things that we'll cover in today's webinar include bullish and bearish divergences, bullish and bearish failure swings, bullish and bearish hidden divergences. We'll talk about an important concept that's called RSI bull market and bear market zones. And finally, we'll conclude by talking about how to use the RSI zones in order to understand the health of the trend and identify whether a shift in trend is taking place. So these are the 5 headings that we'll cover in today's webinar. Towards the fag end of the webinar, I'll also show you the RSI indicator on live charts. So stay with me till the end. So let us get started by talking about divergences. Now there are 2 types of divergences. One is bullish divergence and other is bearish divergence. So first, let's talk about bullish divergence. But before speaking about bullish divergence, let us briefly understand what a divergence is. So a divergence is a concept wherein price makes a particular pattern, either a new high or a new low, but that new high or new low in price is not confirmed by an indicator, in this case, the RSI. So when do we say there is a divergence between the price and an indicator? We say there is a divergence between the price and an indicator when price makes a new high or a new low, but the indicator does not confirm the price. So as we say, there is a divergence between the two. Divergences can be applied on a lot of technical indicators, but it is RSI where divergences tend to work out very well. So let us start talking about what a bullish divergence is. So a bullish divergence forms after a decline in the price of a security. So it typically tends to form near the end of a downtrend. Now, what happens in a bullish divergence is that the price is in a downtrend, as you can see in this hypothetical chart. It makes a new low, which tells you that the selling pressure is pretty much intact, and the sellers are firmly in control of prices. However, if you look at the bottom panel and if you notice the RSI, you will see that the RSI has made a higher low. So if you closely observe, the price is making a lower low, but the RSI is making a higher low. So as you can see, there is a divergence. Now, this is nothing but a divergence. Price is doing something, but RSI is not confirming that. Price is making a lower low, but RSI is not making a lower low. On the contrary, it is making a higher low. So what we have is a bullish divergence. Now, why is this bullish? Because what happens is that the price is making new low. So it tells you that the sellers are still in control. However, that new low is forming with bearish momentum that is not really strong. So as you see, price has made a lower low, but the RSI has made a higher low, which tells you that the bearish momentum is not really strong. So what this bullish divergence tells you is that the selling pressure is probably nearing a climax, and we could probably see a reversal in trend. So that is what a bullish divergence is. A bullish divergence between price and RSI occurs when price makes a lower low while RSI makes a higher low. The opposite of that is bearish divergence. A bearish divergence occurs after a nice rally in price. So typically you will see bearish divergence forming after a sustained rally in price. So price is making a series of higher highs, as you can see in this particular chart. Then on one particular instance wherein price has made a higher high, if you look to the bottom of your panel, you will notice that the RSI has made a lower high. So there is a divergence between the two. And because this divergence is appearing after a sustained rally in price, it's typically bearish in nature, and that is why it is called a bearish divergence. So what this basically tells you is that the price has made a higher high, but that higher high has come in the midst of waning bullish momentum. So as you can see, the bullish momentum is waning, or the bullish momentum is fading. So this high that the price is making is not really that strong. So typically, once you see a divergence, be it bullish or bearish, it typically signals at a reversal in trend. Having said that, you should not act on the basis of divergences just by looking at the RSI. You need to wait for some sort of buy or sell signal being generated in the price itself. So if you want to act on a bearish divergence, that is, if you want to short the security, you need some sort of sell signal that comes in from the price rather than just trading on the basis of the indicator. So before explaining the chart again, let me briefly talk about bullish and bearish divergence. So a bullish divergence occurs after a sustained decline in price. A bullish divergence is a scenario wherein price makes a lower low, as you can see over here, and RSI makes a higher low. And that is why there is a divergence between the two. This is a bullish development, and it typically indicates that the selling pressure could decline and we could see a reversal in price. On the other hand, a bearish divergence occurs after a sustained rally in price. It is a situation wherein the price has made a higher high, but RSI has made a lower high, and hence you have divergence between the two. Now, it tells you that the buying pressure is kind of happening on the back of weak bullish momentum. So it typically tells you that the buying is weak, and going forward, we may see a sort of reversal in price. So here we have the daily chart of Amaraja batteries. So as you can see from the leftmost region on the chart, the price of the security was in a sustained uptrend. In order to look at the angle of the uptrend, I've drawn a trend line connecting this low over here and these particular low over here. So I've drawn the trend line connecting these lows and extended it into the future. Going forward, if you notice, towards the central region of the chart, you will also see that a head and shoulder pattern is forming. In order to learn what head and shoulder pattern is, again, I'll say that I've talked about it in School of Stocks. If you want to learn about what head and shoulder pattern is, you could visit School of Stocks. So typically, just to brief you, head and shoulder is a bearish reversal pattern that forms at the top, that forms after a sustained rally in price. It's called head and shoulder because it resembles a head and shoulder. So you have the two shoulders on the left, and between the two shoulders you have head. Now, as you can see, the head, the top of the head is above both the shoulders. So it sort of resembles a head and shoulder. You can draw a trend line connecting the two intervening lows of the head and shoulder pattern. So see, what is basically happening over here is that the price is in a strong uptrend. Then look at this particular instance. Price has made a higher high over here. But if you look at the bottom panel, you will see that the RSI has made a lower high. So there is a divergence between the price and RSI. But as I said, you should not just outrightly sell whenever you spot a divergence. You should wait for some sort of confirmation from price. And that confirmation came when price broke below this rising yellow trend line and also went on to break this neckline of the head and shoulder, this white neckline. So there is a bearish divergence in price, and going forward, the price is breaking below the yellow trend line and also breaking below the white neckline of the head and shoulder pattern. So here we have a confirmation in price. So this is where you'll be looking out to short the security. As you can see, going forward, there was a nice decline in the price of Amaraja batteries. And now this is the daily time frame chart of Coal India. Coal India is in an uptrend, as you can see, although it's not a very healthy uptrend because the stock is very volatile. But still, if you draw a trend line, you will notice that the trend line is upward sloping, which tells you that Coal India is in an uptrend. So again, I have drawn this trend line connecting this low over here and this low over here and extended it into the future. Now, as you can see, the decline from this high stopped right at this trend line. So you have a series of 5 or 6 red candles. The final red candle is halting right at the trend line. And the candle that follows it, the immediately next candle, is a bullish candle. And from there, the price is starting to rise. So what this chart tells you is that this particular trend line has acted as a support to price. Now, if you look at the bottom panel, the RSI indicator, you will see that the RSI went into oversold after a long time, and then it is slightly come above oversold. So what we have is price taking support at trend line and the RSI touching the oversold region and slightly bouncing off it. Now, how do you act this pattern? Now, I like using dual time frames, the larger time frame, in order to identify which direction I should be trading. Now, in this particular case, the larger time frame tells me that I should be looking out for buying opportunity because price has taken support at the trend line and RSI has moved into oversold region. So it's a basic buy. Now, in order to initiate the trade, that is, in order to decide where I should be entering, I could drill down into lower time frames. So I've drilled down from the daily time frame to the hourly time frame of Coal India. So as you can see now on the hourly time frame, there is a steep decline in price. But this lower low that price is making, the one that is indicated by this downward sloping arrow line, red arrow line, if you look at the bottom panel, the RSI has not made a lower low. On the contrary, it has made a slightly higher low. So there we have it. We have a bearish divergence on the hourly chart of Coal India. So RSI is making a lower low, but price is making a higher low. From there, the price is bouncing off the oversold region. Now, if you look into the chart, price rallied from the bottom, came down a bit, and then there is a very healthy bullish candle that formed. So this small horizontal trend line which is drawn connecting this high. Once price broke above that high, you could initiate a buy trade in Coal India. So this is how you can combine two time frames. The larger time frame to identify the direction of the trade, and the shorter time frame to identify at what level to enter, and in order to determine where I should be placing the stop loss for the trade. So the larger time frame told me that price is taking support at the trend line. On top of that, the RSI has hit the oversold region. So it is putting me on buy alert mode. The daily chart is telling me that you should be looking out to buy the security. Drilling down to the lower time frame, I see that a classic bearish divergence, a classic bullish divergence is formed between price of Coal India and the RSI indicator. Going forward, price has made a low. From there, it has bounced, corrected a bit, and then went on to break above this interim high. So that is where I will place a buy order. Now, what would be my stop loss for this trade? Stop loss I can place below the low of this candle, the final low. So I could place a stop loss, a tick or two below the low of this candle. So this was the first buy signal based on the hourly time frame. Now, in case you missed this, you could have taken another buy over here, wherein price was breaking this trend line, a trend line that is connecting this high and this high. It was broken over here. So you could have initiated a buy over here. In case you missed that also, a third buy could have been initiated over here. Now, what we have here is the inverse head and shoulder. So this is the left shoulder, this is the head, and this is the right shoulder. And then price is breaking, the neckline of that inverse head and shoulder over here. So this was a region where a third buy could have been initiated had you missed the first and the second buy signals. So as you can see, that buy is happening somewhere around 139 levels. So if you go to the daily time frame, that 139 levels is very close to the trend line. So it was a very safe buy signal to initiate. So, so that is how you can use dual time frames, the larger time frame to identify in which direction you should be taking the trade, and the shorter time frame to identify where to enter the trade and what should be your stop loss for the trade. So that was about bullish and bearish divergence. Again, reiterating, a bullish divergence occurs after a sustained decline in price. That is, it occurs after a period of downtrend. It occurs when the price has made a lower low, while the RSI has made a higher low. It is a bullish pattern, and hence once you have a buy confirmation from price, you could initiate a long trade. On the other hand, bearish divergence occurs after a sustained rally in price. It occurs when price makes a higher high, but RSI makes a lower high. So it tells you that the rise in price is coming on the back of weakening bullish momentum. So once you have some sort of sell confirmation from the price, you could go ahead and place a short trade. So that's how you trade bullish and bearish divergences. Again, the important rule to remember is that you must spot these patterns after a sustained rally or after a sustained decline in price. If you spot these patterns in a sideways market, then they may not really work well. So be sure that if you want to trade these patterns, you trade them either after a sustained rally in price or after a sustained decline in price, but not in a sideways market. So now let us move ahead and talk about the next thing that I want to discuss today, which is on failure swings. Again, there are two types of failure swings. One is a bullish failure swing and the other is a bearish failure swing. So let me first explain what a bullish failure swing is. So as you can see, if you look at the top left, hypothetical chart, you will see that the RSI is declining. Now these horizontal, the top and the bottom horizontal dotted lines indicate the overbought and the oversold territory. So the one you see at the top is the overbought, is the RSI overbought zone, and the one you see at the bottom is the RSI oversold zone. So what is happening is that the RSI is declining. It makes a low, rallies very slightly, comes back down again, But instead of breaching the previous low, it sort of makes a higher low, goes up, and then breaks the intervening high. So if you kind of closely see, it sort of resembles a W pattern, wherein the second bottom happens to be above the first bottom. A signal is generated when the RSI line goes on to cross above the intervening high, which is this particular level. Now there are a couple of varieties. Now, if you look at this top left chart, all the bottoms and peaks of the failure swing are happening in the oversold region. It's not necessary that they always happen in oversold region. They could occur right at the oversold region as well, or they could occur just above the oversold region as well. So you need to be aware of this. How to identify this pattern? As I said, they sort of resemble a small W, wherein the second bottom happens to be above the first bottom, and the RSI line goes on to break the intervening high. The opposite of that is something that's called a bearish swing. So it happens after an up move in RSI, and once it has ventured above or near the overbought region. Now this is the polar opposite of bullish failure swing. So while a bullish failure swing resembles a W, a bearish failure swing resembles a sort of M pattern, wherein the second high is slightly below the first high, and then the RSI line goes on to break below the intervening low, which is this point. So I've shown it by drawing a small horizontal white line. So once the RSI line breaks below that white line, you have a confirmation of bearish failure swing. Now, the reason why this is called failure swing is because in case of bearish failure swing, you see that the second high did not surpass the first high. That is, the second high did not go on to cross above the first high. So you have a sort of a failed swing within the RSI. So this is the reason why it's called a failure swing. Again, a bearish failure swing could occur above the overbought region, or it could occur near the overbought region, or it could occur slightly at or below the overbought region. One thing that you need to keep in mind about bearish and bullish failure swings is that they should occur at such extreme levels. That is, a bullish failure swing should occur very close to the oversold region, while the bearish failure swing should occur very close to the overbought region. So you need to be aware of this, because if they occur somewhere in the middle of say the RSI reading, which happens to be 50, RSI is a bounded indicator that fluctuates only between 0 and 100, and 50 is the midpoint of RSI. So if you see a failure swing occurring somewhere around 50, then it's not really that strong. But if you see a failure swing occurring at overbought levels, or if you see a failure swing occurring at oversold levels, then they typically tend to be quite reliable and quite strong patterns. So that is how they look like. Now, as I said, they tend to occur quite close to each other. So it's a very short-term pattern on the time frame that you are looking at. So let me now move into the chart of Bajaj Auto. Now, this is the intraday 30-minute chart of Bajaj Auto. So as you can see, that the rally that started from this low, it sort of showed signs of toppishness over here, because you see that the candles are sort of making lower highs. So it tells you that probably the buyers are running out of steam. They are getting tired. But again, until you have some sort of confirmation, you should not be looking to sell. Now, if you look at the RSI went into the overbought region. So it tested the previous peak. So this high is more or less near this high. So it has gone into overbought. From there, it came down, took support at the overbought region, tried to move higher, and then came down again. So what we have is an M sort of pattern, wherein this second minor bounce in RSI is failing to surpass the first bounce. So you have a sort of M pattern over here. I've drawn a trend line connecting the intervening low. Then at this point, you see that the RSI has broken this trend line and moved below the overbought zone. Now, if you look at the price, just 2 or 3 candles later, the price is breaking below this horizontal low. So I've drawn a white trend line in price connecting the first low. So at this point, you can see that the price is breaking that trend line. So a bearish failure swing that was generated in RSI is now being confirmed by the price action. So here I have a confirmation in price. So this is where I'll be looking out to sell the security, or to say to short the security. Again, what would be my stop loss for this trade? The stop loss is very clearly visible. I could place it a tick or two above the high of this top. That is this candle that you see, the tallest candle. I could place a stop loss above that. Now, again, a similar such sort of pattern happened over here as well. So here you can see price rallied, came down, rallied again. Now we have a sort of double top in price because these highs are coinciding near this high. So we have a sort of double top in price. Then price is breaking that trend line, as you can see in this instance. Now, if you look at the bottom panel, you'll also see that the RSI touched the overbought zone, came down, rallied, touched the overbought zone again. Now it didn't make a new high. It started declining again and then broke below this horizontal trend line. So what we have is another bearish swing failure in RSI. And that more or less coincided with a sell confirmation in the price itself. So a bearish failure swing in RSI is coinciding with a sell confirmation in price itself. So a second sell signal was generated over here. Again, the stop loss for that trade is about this high. So that's how you place a stop loss once you enter a trade. Now, again, I could drill into the higher time frame. So this is the 30-minute time frame. Let me drill into the higher time frame. Let me go to the 60-minute time frame. Now this is the hourly chart, the 60-minute time frame. In the hourly chart, if I see this, Bajaj Auto is in a clear downtrend, and this is the instance where the sell signal was generated on the 30-minute time frame. So if you look on the hourly chart, you'll see that the stock is in a clear downtrend and you are initiating a sell on the 30-minute time frame. So what you're doing is that you're taking a trade in the direction of the larger trend, which is down. So such trades are more reliable than trying to fight the trend. So if you look at the 30-minute time frame, so if you look at the 30-minute time frame, two sell signals were generated over here, and you're initiating a sell in the direction of the larger time frame, which happens to be 1 hour. The 1 hour chart is on a clear downtrend, so you're taking trades in the direction of the larger trend. So again, as I say, you could use two time frames to strengthen the validity of your signal. The lower time frame to execute trades, and the larger time frame to determine the direction and ensure that you're trading in the direction of the larger trend. Now, this is the daily chart of IndusInd Bank. As you can see from the leftmost region in the chart, the stock is in a clear uptrend. The stock is in a clear uptrend. It made a high and started declining from there. Now, if you look at this particular region, the price is sort of trying to make a bottom over here, and that bottom is coinciding with a prior support zone. So I've drawn two trend lines to show the support zone. The top trend line is connecting this low, and the bottom trend line is connecting this low over here. So I've drawn a horizontal line connecting these lows, and I've shown a support zone. Now over here, the price is trying to sort of take support. Let me now go to the RSI and see what the RSI is telling me. So if you look at the RSI indicator, now as I said in my previous webinar, feel free to use trend lines on the RSI. They tend to work exceptionally well. So over here, you can clearly see that the RSI is in a downtrend as shown by the action from this trend line. Then over here, what you have is a bullish failure swing. See that the RSI touched the oversold region, came up from there, tried going down again, but this time it did not make a new low. It has made a higher low, started rising, and then it is going on to break above this, the intervening high, the one that is shown using this small line, this small horizontal line. So the RSI is breaking that, and immediately it is also breaking this larger downward sloping trend line. So what we have in the RSI is that we have a confirmed bullish failure swing, and we have RSI breaking above this trend line. So the RSI is telling you that the bearish momentum is fading, and the momentum is trying to turn bullish. In the meantime, you'll also see that the price is trying to carve in a bottom right near the previous support area. So we have a good trade that is panning out over here. But again, to find out where to enter the trade, you could drill down to the lower time frame. So let me say you drill down to the hourly time frame to see where to enter the trade and where to place the stop loss. Again, you can see that decline that is coming on the daily chart is coming in the form of an inverse head and shoulder. Now, if you look at the daily time frame, this inverse head and shoulder is not so clearly visible. But if you look at the hourly time frame, this inverse head and shoulder is very clearly visible now. So we have an inverse head and shoulder. That inverse head and shoulder is occurring when price is also forming a bullish divergence with RSI. So see that the price has made a lower low over here, but RSI has made a higher low. So that's your first warning that the bearish momentum is fading, and going forward, price is going on to surpass this downward sloping neckline connecting the intervening highs of the head and shoulder. So we have price breaking above this downward sloping neckline. So that's a classic head and shoulder buy. So see how we have used two time frames over here. On the larger time frame, we are seeing that the price is taking support near a previous support zone. On top of that, we have a bullish failure swing being confirmed. We also have RSI moving above the trend line. So we have good evidences that this decline that started from here is coming to an end. So the daily chart tells you that you should be looking out for buying opportunities because the risk is very small. Even if you get stopped out, the stop loss is very small. This low could be your one potential stop, or you could place a stop loss below this. Then if you drill to the hourly time frame, we see that there is a bullish divergence that formed between price and RSI. And later on, we also see that price is breaking below and the price is breaking above an inverse head and shoulder pattern. So we have confirmation from the larger time frame, which is daily, and we have confirmation from the hourly time frame also. So a classic buy signal was generated over here. Now, again, what should be the stop loss? Now, one possible stop loss could be below the low of this pattern, or you could also place a stop loss below the low of the right shoulder. So that is somewhere below this, and you could fixate on your target accordingly. So that was about bullish and bearish failure swings. So now let's talk about a relatively unknown but a highly useful feature of RSI that is called hidden divergences. Now, hidden divergences are something that not everyone who uses the RSI knows, but they are an exceptional patterns. Whenever you spot them, they tend to work exceptionally well. They are very reliable. And the beauty is that these hidden divergences occur in the direction of the trend itself. Now, if you remember the normal divergences that I talked about earlier, they occur after a sustained rally or after a sustained decline. And the normal divergences, if you remember, they are reversal patterns. On the other hand, hidden divergences are typically continuation pattern. Again, hidden divergences is a concept that was talked about a person known as Andrew Cardwell, who is one of the most renowned authority on RSI. So Andrew Cardwell is a person who has researched a lot on the RSI and has developed some really useful trading strategies that can be made from RSI. Hidden divergences are one of his well-known works on the RSI. So as you're all aware of, divergences are of two types. In a similar fashion, hidden divergences are also of two types. They could either be bullish or they could be bearish. So let's talk about what a bullish hidden divergence is. Now, as I said earlier, these are continuation patterns. So a bullish hidden divergence forms when the price is already in an uptrend. So price is making a series of higher highs and higher lows, and that is when a bullish divergence you'll typically spot. Now, what is this pattern? If you look at this particular price action over here, the price is making a higher low, which tells you that the uptrend is very much intact, because that is what an uptrend is about. Uptrend is a sequence wherein the price is making higher highs and higher lows. So if you look at the price chart, everything is normal because price is made a higher low. But then if you look at the bottom panel of the RSI, you will see that the RSI has made a lower low. So what we have is price is making a higher low, but RSI is making a lower low. So what this tells you is that the RSI is sort of getting oversold, but at a relatively higher price. Now that's a very reliable pattern. So whenever you spot a bullish, a bullish hidden divergence, or for that matter, even a bearish hidden divergence, pay very careful attention to it, because the unfolding move could be very powerful. So bullish hidden divergence occurs when a price makes a higher low, but the RSI goes on to make a lower low. So as you can see, there is a hidden divergence between the two. Now, the opposite of that is, a bearish hidden divergence. A bearish hidden divergence occurs following a decline in price. That is, you will see a bearish divergence occurring in a downtrend. Now, this is the polar opposite of a bullish hidden divergence. So what happens in this case is that the price makes a lower high, which tells you that the downtrend is very much healthy and intact. But the RSI has made a higher high, as you can see. The price is making a lower high, but the RSI is making a higher high. So what this tells you is that the RSI is sort of becoming overbought, but at a relatively lower price. So that's a very bearish signal. So whenever you see such an occurrence occurring, the price of the security in question could come under severe selling pressure going forward. So these are patterns that are not well known. Now, normal divergences are well known by a lot of traders who use RSI, but hidden divergences are not well known. Also, I would again reiterate that they are quite reliable patterns. So whenever you spot them, it is worth trading them depending on your risk reward expectations. So as I said, divergences are continuation patterns. Now here is the daily chart of the Nifty 50 index. As you can see, the Nifty is in a very nice uptrend. Now look at this particular instance. The uptrend is very much intact because the price of Nifty is making a higher low. But then if you notice at the RSI, you will see that it has made a significantly lower low. So what it tells you is that the RSI is trying to get oversold, but at a relatively higher price. The price is high, but the RSI is getting oversold. So that's a very strong hidden divergence that you're seeing between Nifty and the RSI. And as you can see, when this pattern occurred, the immediately following candle was very bullish, and then price went on to make a new high and continue the uptrend. So typically you will see that whenever a bullish hidden divergence forms between the price and the RSI, going forward in time, the price typically tends to make a new high. So that is how you can capitalize on bullish divergence. Now, again, how do you enter the trade? So on the daily time frame, we clearly see that there is a bullish hidden divergence, but how to enter the trade? So where to enter and where to place a stop loss? Again, you could use dual time frames. The larger time frame over here, that is the daily chart, is alerting me to be on the lookout for buy opportunity. I can drill down to the intraday time frame to determine the level where I'll buy. So let me go to the hourly chart again. So as you can see, after a sustained decline in price, it made a low, it rallied, it declined again. Now, as you can see, the price has made a lower here. But if you look at the hourly RSI, the RSI has made a higher low. So now here we have a bullish normal divergence. The price is making a lower low. The RSI is making a higher low. And going forward in time, you can see that the price went on to surpass this high, the high that is drawn with the help of this horizontal trend line. The price went on to break above that high. So here a buy signal was generated. So how do you trade the pattern? You buy when price breaks above this horizontal trend line. That is when price surpasses this high, and you could keep a stop loss below the low of this decline. So this was the low. This was the lowest point of this decline. So you could have placed a stop loss somewhere below that. So see how a larger signal is generated on the daily time frame in the form of a bullish hidden divergence, and then we are drilling down to the lower time frame wherein we are spotting a normal bullish divergence, and then there is a subsequent break in price. So that is how you can determine where to enter and exit the trades. So trust me, dual time frames tend to work very well. So you use a larger time frame to determine in which direction you should be trading, and then you use a shorter time frame to determine what should be your entry and exit level. Now, let me talk about another chart. Now, this is the 2-hourly chart of Petronet. So initially, Petronet was rising, as you can see. Then at this point, it broke the rising trend line and started a precipitous fall. It rallied from there, it declined again, and then rallied again. Now, if you look in this particular instance, the price is making a lower high. So we have a lower high in price, which tells you that the downtrend is intact and that the sellers are the dominant force. But if you look at the RSI, you will notice that the RSI has made a higher high. So what we have is we have a lower high in price and we have a higher high in RSI. So what this tells you is that the RSI is sort of getting overbought, but at a relatively lower price. So again, it's a hidden signal because it's not clearly visible to the eye. But if you see that, the subsequent decline in the price of Petronet was very powerful. So once this bearish hidden divergence formed, then from there, Petronet went on to make a new swing low. Now, again, how to enter the trade? On the 2-hourly time frame, we have a bearish hidden divergence. Now, how to enter a trade? For that, again, I can drill down to the lower time frame. So let me, I've selected the 30-minute time frame over here. Now, this steep rally that you are seeing corresponds to this rally on the 2-hourly time frame chart. So see that after that steep rally, the price broke below the trend line, but instead of moving lower, it turned sideways. And that sideways consolidation is happening within a shape of a descending triangle pattern, wherein the upper trend line is sloping down and the lower trend line is sort of horizontal. And then eventually you have a break below the lower horizontal trend line. So what we have over here is a short trade signal that is generated on the 30-minute time frame. Also, if you look at the bottom panel of RSI, precisely when the price made this high, you will see that the RSI ventured into overbought zone. So that tells you that the bullish momentum is somewhat extended. Going forward, if you notice, we have a bearish failure swing over here. We have the first high over here. The RSI declined, went back up again, but it did not make a new high and then went on to break below this intervening low. So bang at the top, what we have is a bearish failure swing. And then subsequently, if you see, the RSI also broke below this rising trend line. Now, if you see that this breakdown in RSI is occurring before the breakdown in price occurred, so I would like to say that RSI typically tends to lead price action. So the RSI tends to generate a signal early, but that doesn't mean that you should be acting when the RSI generates a signal. Your actual buy-sell decision should only come when the price has generated the signal, and that is occurring at this point. So again, going back to the previous chart, on the larger time frame, we had a bearish hidden divergence that formed between price and RSI. And on the lower time frame, we have price breaking this upward sloping trend line, and we have a price breaking below this descending triangle pattern as well. On top of that, we had a bearish swing failure in RSI, and we also had RSI breaking below this trend line. So we had several confirmations in case of this chart. So you could have initiated a short position over here in Petronet, and you could have placed a stop loss above the high of this descending triangle pattern, which happens somewhere over here. So that is how you trade, bearish and bullish hidden divergence. Now, if you go to School of Stocks, Later on, I'll show you. Now, there is a way to calculate targets based on bearish and bearish hidden divergence and bullish hidden divergence. I've explained about that in School of Stocks. Towards the fag end of this webinar, I'll precisely show you wherein I've explained how to calculate price targets on the basis of hidden and bullish and bearish hidden divergence. So stick with me till the end. So that's about the hidden divergence. Now let's focus on another relatively unknown aspect of RSI, which is called RSI zones. Again, RSI zones is a strategy that was made famous by Andrew Cardwell again. So he was the one who made this strategy very popular, and he introduced this strategy. So what are RSI zone? Now, as you know from my webinars, from my last and this webinar so far, RSI typically tends to fluctuate within a band of 30 and 70. So whenever RSI drops below 30, it's considered oversold. And whenever RSI rises above 70, it's considered overbought. However, this 30 and 70 zone tends to hold well in a market that is consolidating or that is in a sideways trend wherein neither the bulls nor the bears are in control. So in a market wherein neither the buyers nor the sellers are in control, the RSI typically tends to fluctuate between 30 and 70 from the leftmost region of the chart till the rightmost region. Having said that, whenever the market is trending, that is, whenever the market is in a strong uptrend or in a strong downtrend, the behavior of RSI will vary. And that is what we'll talk about in this section. So this is the daily time frame chart of Coromandel. So as you can see from the leftmost region to the rightmost region, the price is sort of consolidating. You can see that neither the bulls nor the bears are clearly in control. And then if you look at the bottom panel also, look at the two horizontal dotted lines. The one on the top, that is this line, represents the overbought region at 70. And the one at the bottom, that is this line, represents the oversold region at 30. So if you notice that for most of the time, that is for a bulk of this chart range, you will see that the RSI is steadily fluctuating within a range of 30 and 70. So it's barely, crossing above 70, and on the downside, it is barely touching, barely going below 30. So it's steadily fluctuating within this band of 30 and 70. So just by looking at the RSI, you can sort of get a sense of the price, that the price should be in a consolidation zone, which is what is happening over here. If you look at the price chart of Coromandel, it's neither clearly trending up nor clearly trending down. So in a sideways market, there is a tendency for the RSI to fluctuate between 30 and 70. However, when the market starts to trend, the behavior of the RSI tends to change. So let me talk about how the RSI behaves in a bull market. So typically, in a bull market, you will see that the RSI fluctuates between 40 to 80. In a normal sideways market, the typical range for RSI is 30 to 70. But in a bull market, the range of RSI will typically shift upwards between 40 to 80. That is, the RSI will get overbought when it touches 80 and beyond, while it will get oversold whenever it approaches within a range of 40 to 50. So in a bull market, the zone within which the RSI fluctuates is typically between 40 to 80. Now, as long as the RSI continues to fluctuate between 40 to 80, you can be sort of assured that the price is in a bull market and the bull market is sort of intact. So how to use this opportunity is that whenever price is in a bull market and RSI is fluctuating between 40 to 80, you could use approaches towards the 40 region to buy the security whenever you have confirmation from price, and whenever price goes above 80, you could use to lighten up your long positions. So that's how you can take advantage of being aware of the RSI bull market zone. Now, sometimes what happens is that when the security is in a very powerful bull market, the RSI will even rise to say 90 or beyond. And on the downside, it will not, it will get oversold whenever it approaches to 60 or 55. So in a market that is in a very powerful bull trend, the RSI range could even be something like 60 to 55 on the downside and 90 on the upside. So how the RSI is behaving tells a lot about what sort of uptrend you are in, whether you are in a normal uptrend or whether you are in a very powerful uptrend. So that is how the behavior of RSI will vary. Now, this is the daily chart of the Nifty. Now, if you look at the two horizontal lines, you'll notice that I've shifted them upward. So I've shifted the upper horizontal line upwards from 70 to 80, and I've moved the lower horizontal line upwards from 30 to 40. Now, why did I do that? Because if you look at the RSI, it is barely moving below 40. On the other hand, on many occasions, it is easily surpassing 70, and it is trying to touch the 80 levels quite often. Why is that happening? Is because the Nifty, right from the left of the chart to the rightmost region, you will see that the Nifty has been in a strong uptrend. As a result, whenever the RSI is approaching the 40 zone, which is the support in a bull market, you will see that the Nifty is bouncing right from the 40 zone. On the other hand, the upside in the RSI is extending to 80 and beyond. So see that from the leftmost region of the chart till the rightmost region, the RSI is steadily fluctuating within a band of 40 to 80. And as long as the RSI continues to fluctuate within this band, what it tells you is that the uptrend is intact and is very healthy. And what sort of trading strategies can you deploy? Well, whenever the RSI falls to oversold region of 40, you can sort of buy. And whenever the RSI is crossing above 80, you can sort of lighten up your buy positions. Now, RSI bear market zone. This is the opposite of the bull market zone. So typically what happens is that in a bear market, the RSI will tend to fluctuate between a range of 20 to 65. That is, whenever the RSI approaches 20 and below, it will get oversold. And whenever it approaches 60 to 65, it will get overbought. So in a bear market, you will see RSI struggling to touch 60, 65 levels. But on the downside, you'll see RSI hitting 20 to 25 levels pretty frequently. And as long as the RSI continues to fluctuate within this zone, you can be sure that the bear market is very much intact, and you can be using the overbought regions of 60 to 65 to sell, and the oversold regions of 20 and below to sort of trim on your existing short positions. So this is the weekly time frame chart of Coal India. So as you can see, Coal India has been in a downtrend from the leftmost region in the chart. If you look at the RSI, notice that I've moved the horizontal dashed lines downwards. That is, I've shifted the upper horizontal dash line downwards from 70 to 60, and I've moved the lower horizontal line downwards from 30 to 25. See that on a bulk of the occasion, within this chart, that is from the leftmost region to the rightmost region, whenever the RSI is touching 60, 65 levels, it is sort of getting overbought. And whenever the RSI is approaching towards 25 levels, it is sort of getting oversold. Now notice this high over here. It more or less coincided with a peak in price. And in this particular instance, the RSI hit the overbought region of 60, 65. Again, the price stopped out and started declining. So see how well the zones of 60 to 65 work in a downtrend. Now in this particular instance, the RSI again hit the overbought zone of 60, 65. From there it declined. See that the price also came down once the RSI hit the overbought zone. Now the subsequent rally from price, the subsequent rally in RSI has taken the RSI above, the threshold of the bear market, above the upper threshold of the bear market. So what is happening over in this particular instance is that following this steady decline, the price has turned sideways and the behavior of the RSI is also sort of changing. Now, that is the topic of my next discussion, wherein I'll talk about how to use RSI zones in order to understand when the trend is sort of shifting from down to up or up to down, as the case may be. But if you look at this Coal India chart, towards the fag end of the chart, you will see that the RSI went on to surpass this overbought region of 60-65. It made a new high, as you can see. It has come down, but this time the RSI is sort of taking a support near the 40-45 level, which happens to be the lower bounds of bull market. So if you remember how RSI behaves in a bull market, so typically RSI fluctuates in a band of 40 to 80, with 40 acting as a support zone. Now, what is happening in case of Coal India is that in this particular instance, for several weeks, the RSI is not going below 45. So what this tells you is that the selling pressure is sort of ebbing, and what could unfold is that maybe Coal India is trying out to bottom. So the RSI is also indicating at that. So the RSI is telling you that there could be a potential zone shift which is happening, which tells you that the trend could be reversing, and that is what we'll talk about in the next section, which is to discuss about how to use the RSI zone in order to identify whether trend shift is happening or not, and in order to identify the health of the trend. So that is what we'll discuss in this final section of today's webinar. So as I said, in a sideways market, that is in a market that is not trending up or down, RSI typically fluctuates between 30 and 70. In a bull market, RSI typically fluctuates between 40 and 80, while in a bear market, RSI typically fluctuates between 20 to 65. However, when a trend is about to change, the RSI gives you subtle clues that the zone is sort of shifting. So typically when you are in a bull market, the RSI, as I said, fluctuates from 40 to 80. But when the uptrend is maturing, the RSI will start to shift its stance and start to move lower, as you can see in the case of this Coal India chart. So initially the downtrend was sort of intact, wherein the RSI fluctuated between a band of 20 to 60. But towards the fag end of the chart, you will see that the RSI is not going below 40-45 levels. So the RSI is taking support at the bull market support zone, which happens to be 40 to 80. And on the upside, the RSI has surpassed the bear market resistance zone of 65. So this is a sort of warning that probably there is a shift in trend that is occurring in case of Coal India. Again, let me reiterate that you must use RSI zones only to gauge the health of the trend and in order to identify whether the trend is shifting or not. The actual buy and sell signals should be generated from other tools. Don't use RSI zones to generate buy and sell signals. The actual buy and sell signals should come from other price tools. Now, this is the daily chart of JSW Steel. As you can see from the leftmost region of the chart, the stock has been in a steady downtrend. And if you look at the bottommost region, when JSW Steel was declining, you will see that the RSI was moving within a band of 20 to 65. So during this entire downtrend, the RSI was fluctuating within this band. So whenever the RSI was approaching 65, price was topping out and declining from there, which is what happened over here as well. But then what happened is that, from this region onwards, the price started rallying. But if you look at the RSI went on to surpass the 65 level. So in this particular case, that is when the price approached near the resistance of this upward trend line, the RSI surpassed the resistance zone of the bear market, which happens to be 65. The RSI surpassed that. For the first time, RSI went well above 80. So what is happening is that after a very long time, the RSI is not only going above the resistance of bear market zone, which is 65, but it is also going to as high as 80 and above. So what we have is that we have a mega overbought following a sustained decline in price. Now, whenever that happens, that is a very strong signal. The first mega overbought in following a sustained decline in price warns you that a trend reversal could be happening. And if you notice, when the RSI hit the mega overbought zone, the price also moved out of this channel. That is, the price is breaking above the upper trend line of this channel. So we have a breakout in price, and we have a potential zone shift in RSI. So if you look at this red region, during this entire red region, the price moved between 20 and 65. But during this portion over here, the price has the RSI has rallied sharply and is is hitting the mega overbought region of 80. So what this tells you is that a zone reversal could be happening, and at the same time we have a breakout in price as well. So see what is happening. So here price is becoming overbought, mega overbought. So I've shown that using this arrow in price as well. Then there is a very minor decline in price, but the RSI is falling sharply. This time it is not moving to 20, which is the support zone within a bear market. Instead, it is taking support at 40, which is the support zone, which is the RSI support zone in a bull market. So what is happening is that the RSI has first hit 80. From there, it has declined, and now it has taken support at 40. So this is a very strong signal that there is a potential shift in trend in the price of JSW Steel from down to up. And as you can see, going forward, JSW Steel entered a period of prolonged uptrend. Now, in this green shaded box, if you see during this entire uptrend, you will notice that on the upside, the RSI is, is sort of approaching 80, while declines in RSI are halting right at 40. So whenever the RSI is approaching 40, the price is starting to rally from there. So, so this zone shift, that is, the trend was reversing, was signaled over here by the action in the RSI. So that is how you can use, RSI zone shifts in order to identify whether a trend reversal in price is happening or not. So this was a very classic chart of JSW Steel, wherein we see a very nice zone shift. Now, one thing to keep in mind is that this is a lagging indicator. So if you remember, if you see in this particular case, buy signal is being generated over here. So by then there has been a very substantial rally in price. But that's one drawback of zone shifts. But nonetheless, whenever zone shifts occur, the unfolding move going forward tends to be very powerful, as you can see in the case of this chart. So once there was a zone shift, the stock of JSW Steel entered a prolonged uptrend. So although the buy signal is being generated pretty late over here, but the unfolding move, as you can see, has been very powerful. So get used to learning how to use RSI zones. Again, let me just repeat. In a bull market, the RSI typically tends to move between 40 and 80. So 40 is a sort of bull market support zone to the RSI, and 80 is a sort of bear market, a bull market resistance zone. Similarly, when RSI is in a bear market, it typically tends to fluctuate between a zone of 20 to 65, with 20 acting as the bear market support zone and 65 acting as a bear market resistance zone. Whenever there is a zone shift, as you can see in the case of this JSW Steel, the RSI will swiftly move to the overbought region of bull market, which happens to be 80 and above, and subsequent decline from there will halt at 40, which happens to be the bull market support zone. So that's a classic evidence of potential zone shift. So that is how you can use these signals to generate broader signals. Again, let me repeat that RSI zones should typically be used on the daily time frame chart. Refrain from using them on, say, 5-minute or 10-minute chart. So they are typically broader patterns. They are generated well on daily time frame charts. So these patterns are typically longer in nature. So typically when you'll be buying or selling a security based on zone shift, you will be doing so when you have a very big target and a relatively bigger stop loss as well. So this is typically not for intraday, more for very positional trades. But these are this RSI zone shift is a very significant pattern, and it is something that not everyone who uses RSI is aware of. But if you learn how to use RSI zone shifts, you could offer yourself a significant edge when trading for the long term. So that was all that I wanted to talk about in today's webinar. So let me reiterate, I spoke about 5 aspects in today's webinar. So one was divergence, the other was failure swings, the third was hidden divergence, the fourth was RSI bull and bear market zones, and the fifth was using RSI zones to identify shifts in the trend of a security. So let me quickly go to 1 minute. Let me quickly go to the the chart. So this is the daily time frame chart of Nifty. The pattern that I spoke about, hidden divergence in Nifty was this one. So this, as you can see, there is a lower low in RSI, and that is coinciding with a higher low in the price of Nifty, and the unfolding move, as you can see, was very powerful. So the rally that followed was very powerful. You will spot many such securities where such hidden divergences occur. Again, let me go to School of Stocks, because I talked about how to use hidden divergences to determine targets. So this is the homepage of School of Stocks. So within that, you have a module called technical analysis. Just click on that. Within technical analysis, there is a chapter called technical indicators. If you click on that and scroll down to the section on RSI, so here I've talked about the RSI formula, which I already covered in my last webinar, and I also showed you how to calculate RSI in Microsoft Excel. Now that is something that's very valuable, because once you know how to calculate RSI in Microsoft Excel, you can use you can code it to generate trading signals by combining with other patterns. So you can automate trades if you know how to use RSI on Microsoft Excel. I've also talked briefly about bull and bear market zones in this webinar, and then I've spoken about concepts called positive and negative reversals. Now, this is nothing but positive and negative hidden divergences. A positive reversal, the other name of positive reversal is positive hidden divergence, and the other name of negative reversal is negative hidden divergence. So they are one and the same. In this particular instance, if you read this paragraph, you'll understand how to calculate them. So over here, if you go through this section, in this chart, I've talked about how to calculate price targets based on hidden divergences, which in this particular chapter I've called it reversals, positive and negative reversals. So how to calculate price targets I've shown in this chapter. So in case you want to refer, you could visit School of Stocks. I didn't want to explain it in webinar because it's a little complicated to understand at first, because you need to do a few additions, subtractions. So to keep things simple, I didn't explain it in the webinar. But if you want to learn it, you could visit School of Stocks, to understand how to project price targets using hidden divergences, that is positive and negative reversal patterns. Let me just show you now. This is trading view. Let me just show you the recent instance of the dollar index, which is a proxy, which is a proxy for the dollar's performance against 6 of the world's largest currencies, which includes euro, Japanese yen, British pound, Swiss franc, Swedish krona, and Canadian dollar. So recently in the chart of the dollar index, if you see, there was a hidden divergence. So if you look at the RSI at this instance, it made a lower low. But then if you look at the price during this instance, it has made a higher low. So see that price has made a higher low, the RSI has made a lower low. So it is telling you that, the RSI is getting oversold at a relatively higher price level, and see that once, this positive hidden divergence, or once this positive reversal formed, the dollar index bottomed and started rallying. So, so this was the latest instance wherein you could spot a hidden divergence in the case of dollar index. Likewise, you could do for other securities as well. Similarly, if you look at this particular region, the price is making a higher high, but the RSI is making a lower high. So what we have over here is a normal bearish divergence, and see that there was a brief decline in the dollar index once this divergence formed. Similarly, if you look at the bottom of the chart, see that in this particular instance, price is making a lower low. But if you look at the RSI, the momentum started to fade, and in this particular region, the RSI is moving higher. So the RSI is moving higher. So what we have is a sort of bullish divergence that sort of formed between price and RSI. And when this bullish divergence formed, see that the price bottomed out, and you could have initiated a long trade over here. Again, as I said, you need confirmation from price. Just because there is a divergence doesn't mean you should outrightly buy or sell. You need some sort of confirmation from price, and that confirmation came when price broke out over here. The stop loss for this long trade could have been below the low of this pattern. So that is how you could spot the normal divergences. You could spot the hidden divergences. You could use the RSI bull and bear market zones, the zone shifts, etc. As I said in my last webinar, RSI is a very, very, very versatile and one of the most used and widely used indicator. There are certain aspects that like hidden divergences and RSI zones that are not well known, but once you understand how to properly use these vital aspects of RSI, you could make you could spot some great trading opportunities once you learn how to use these tools. So that was what I wanted to talk about in today's webinar. So let me, I guess Suruchi has answered, my colleague Suruchi has answered some questions. Suruchi, you're there? Okay, I'm not seeing Suruchi, so I can see that she has been answering some questions. So if you have any questions, you could ask me over here. So one question that I'm seeing is, does RSI work best on stocks or index? What is the ideal time frame? Well, RSI works on all traded securities. It works in stocks, it works on currencies, commodities, bonds, indices like Nifty, MCX commodity index, etc. It works on all traded securities, and it works on all time frames. The only thing that I would like to add over here is that whenever you are using RSI bull and bear market zones, ensure that you typically are doing it on either daily or weekly time frame and not on the intraday time frame. So the RSI bull and bear market zone are used to generate larger signals, and they are not for shorter term signals. But every other aspect that I've spoken about in over the last two webinars, you could use it on all time frames, be it on 1 minute time frame, 1 hour time frame, daily time frame, monthly time frame, etc. There are too many questions. Actually, the moment I spot one question, new question is coming in, because of which the old question is going out of view. So what we can do is, in case you have any question relating to RSI, it will be difficult for me to answer so many questions. So what we can do is, in case you have any question relating to RSI, in case you have any questions relating to this webinar and the last, you could send me a message on my Twitter handle. I tend to be pretty active on my Twitter handle. So my Twitter handle, as you can see over here, is @AB Chinchalkar. So you could DM me any questions, or you could message me any questions that you have on RSI, and I'd be able to, I'd be happy to answer those questions as soon as I can. So yeah, so that's it from my end. Again, I would, if you're interested in learning about financial markets, I would suggest you visit our School of Stocks homepage to learn various aspects of financial markets. We have written some wonderful modules on every aspect. So you can see modules on options, option strategies, futures. You can also see modules on intermarket analysis and sector rotations. If you want to learn about financial markets, I would highly recommend you visit School of Stocks. Again, in case you have any questions, you could reach out to me on my Twitter handle, and I would be happy to address your questions. So with that, I thank you all for attending this webinar on a Friday. I'm sure it has been a pretty hectic week for you. So thank you all for attending this webinar, and I hope that I've been able to shed in some information on RSI over the last two webinars. So I hope that you start using them whenever you trade, because RSI is one of the best indicators. It's a very versatile indicator, and you can do a lot of things from RSI and generate some, excellent trades. So get into the habit of using RSI. And in case you have any questions, you could reach out to me on my Twitter handle, and I would be happy to help. So that's it from my end. With that, we'll end today's webinar, and we'll soon announce the date for next webinar. So I hope to see you all next time around. So thank you so much, and have a great weekend. Thank you all.